you're being distracted. While everyone is obsessing over the next AI stock or the Fed's latest inflation print, a financial time bomb ticking since 2020 is about to detonate. It's not a secret you'll find in the headlines. It's a $1.8 trillion corporate debt wall set to crash down in 2025. And in this video, I'll show you exactly which companies are the zombies standing right in its path, and the 3-step survival guide to protect your portfolio before it's too late. And we're going to cover it all, chapter by chapter, so you can skip to any section you need using the timestamps in the description below. Stick with me because the information in the last 3 chapters could be the most important you hear all year. So, how did we get here? How did corporate America rack up a debt tab so big it threatens to destabilize the entire market? To understand that, we have to go back to 2020. The world shuts down. Economies are in free fall. And the Federal Reserve, in an attempt to prevent a complete collapse, does something unprecedented. It slashes interest rates to effectively zero. It was basically free money. For corporations, this was a siren song they couldn't resist. They went on a historic borrowing binge. Companies that were healthy borrowed to buy back their own stock, artificially inflating their share prices. Companies that were struggling borrowed just to keep the lights on. Private equity firms loaded up their portfolio companies with cheap leveraged loans. The total amount of corporate debt skyrocketed. We're talking trillions of dollars issued with interest rates of maybe 2-3%. It was a party, but every party has a hangover. And that hangover is called the maturity date, the day the loan comes due. Most of that cheap debt issued in 2020 and 2021 wasn't a 30-year mortgage. It was short-term, typically 5 to 7 years. And the due date for a huge chunk of that debt is right around the corner. Welcome to the maturity wall. Look at this. This is the problem everyone is ignoring. Between 2025 and 2026, a staggering $1.8 trillion of corporate debt comes due. To be clear, these companies don't just have $1.8 trillion sitting in the bank. They have to refinance. They have to go back to the market, hat in hand, and ask for a new loan to pay off the old one. But here's the killer. The world has changed. The Fed, in its fight against inflation, has hiked interest rates at the fastest pace in history. That 2% loan from 2020? Today, a company is lucky to get a new one at 5 or 6%. That's a 300% increase in their interest costs. Imagine your mortgage payment tripling overnight. Could you handle it? Many of these companies can't. Goldman Sachs estimates that this rate shock will suck an extra $70 billion out of corporate profits annually. Money that would have gone to hiring, innovation, or profits will now go straight to the banks just to service their debt. This brings us to the most dangerous part of this crisis: the zombie companies. What's a zombie company? It's a firm that is technically alive but practically dead. They don't generate enough profit to even cover their interest payments. Their entire existence depends on their ability to constantly refinance their old debt with new debt. They are the walking dead of the corporate world. The key metric to spot a zombie is the interest coverage ratio, or ICR. It's simple: a company's operating profit divided by its interest expense. If that number is below 1, it's a zombie. For years, low interest rates allowed these zombies to multiply. But now, with refinancing rates soaring, their life support is being cut off. And as you can see, they are concentrated in some very specific, very vulnerable sectors. A shocking 12.3% of all real estate companies are zombies. 9.2% in telecom. 8.5% in retail. These aren't fringe players. These are major sectors of our economy, infested with companies that are one rate hike away from default. Take commercial real estate. It's facing a perfect storm. Work from home has crushed office demand, property values are down 30% or more, and they have $450 billion in debt coming due. Telecom companies are drowning in debt from their 5G buildouts while their revenues stagnate. And we all know the story of traditional retail. Before a company goes bankrupt, there's often a warning shot. In the bond market, this is called a fallen angel. This happens when a bond is downgraded from investment grade status to junk status. Specifically, when a bond rated BBB gets cut to BB+. Why does this matter so much? Because huge institutional investors, think pension funds, insurance companies, are often mandated by their own rules to only hold investment-grade bonds. The second a bond becomes a fallen angel, they are forced to sell it immediately. This forced selling floods the market, cratering the bond's price and making it nearly impossible for that company to borrow more money. It's a death spiral, and the fallen angel pipeline is flashing red. This year alone, $42 billion worth of bonds have already been downgraded to junk. Projections show that could hit $70 to $90 billion by the end of 2025. There are currently $387 billion of BBB bonds on negative outlook. They are sitting on the edge of a cliff. The first wave of the default crisis won't be outright bankruptcies. It will be a wave of fallen angel downgrades that triggers a panic. Okay, this is the core of the problem. A $1.8 trillion wall, soaring refinancing costs, and an army of zombie companies about to have their life support cut off. It's a lot to take in. Before we get to the solution, and I promise there is a clear 3-step plan to protect yourself, I want to hear from you. Which sector do you think is the biggest ticking time bomb? Is it commercial real estate, telecom, or another zombie-infested industry? Let me know your thoughts in the comments below. I read every single one. Now, don't go anywhere. The next part is the most critical, the Investor Survival Guide. This is where we turn this threat into an opportunity. All right, let's talk strategy. In a crisis like this, playing defense is your best offense. The first step is simple but brutal. You must reduce your exposure to the most vulnerable parts of the market. This means you need to audit your portfolio right now for companies with these red flags. First, high leverage. Any company with a debt-to-EBITDA ratio over 5 is in the danger zone. Second, a weak interest coverage ratio. If their ICR is below 2, they have very little wiggle room. Third, their credit rating. If you own bonds, anything rated BBB or below is on the chopping block, especially if it's on negative outlook. This also applies to sectors. Be extremely cautious with REITs exposed to office or mall properties, traditional telecom carriers, and non-essential retail. This isn't about timing the market. It's about getting out of the direct path of the steamroller. Step 2 is about moving your capital from the danger zone into a fortress of safety and quality. In a credit crisis, liquidity is king. When panic sets in, the ability to sell an asset without its price collapsing is everything. And quality becomes paramount. So, where do you go? First, in the corporate bond space, you move up the quality ladder. Look for A-rated bonds or higher from companies with rock-solid balance sheets and wide moats. Think about businesses with inelastic demand for their products. Also focus on short-duration bonds maturing in 2 to 5 years. This dramatically reduces your sensitivity to any further interest rate hikes. Second, and most obviously, U.S. Treasuries. They offer yields over 4% with effectively zero credit risk. They are the ultimate safe haven asset in a storm. During a crisis, capital floods into treasuries, which can actually push their price up, giving you a positive return while other assets are crashing. And finally, don't underestimate the power of cash. With money market funds currently yielding over 5%, holding cash is no longer a drag on your portfolio. It's a paid option to wait. It gives you liquidity and the ability to buy great assets at a discount when the panic eventually subsides. Step 3 is about strategic positioning. It's not just about hiding, it's about rotating into sectors that are resilient to economic downturns. These are the classic defensive sectors. First, consumer staples. People will cut back on vacations and luxury goods, but they will still buy toothpaste, toilet paper, and Coke. Companies like Procter & Gamble or Coca-Cola have stable, predictable cash flows. Second, utilities. People pay their electricity and water bills no matter what the economy is doing. These companies often operate as regulated monopolies, which gives them very secure earnings. And third, healthcare, but be very selective. We want to avoid the highly indebted hospital operators we talked about. Instead, focus on large-cap pharmaceutical giants with diverse drug portfolios and medical device manufacturers. People need their medicine and medical procedures regardless of a recession. For more advanced investors, you can consider hedging. You can buy credit default swaps, or CDS, which are basically insurance policies on bonds. Or use options like buying protective puts on high-yield bond ETFs like HYG or JNK. This directly profits if the credit market deteriorates. So let's bring it all together. The market is distracted. A $1.8 trillion debt bomb is set to go off in 2025 as companies are forced to refinance at cripplingly high rates. This will awaken an army of zombie companies, trigger a wave of fallen angel downgrades, and likely cause a severe credit crunch and a spike in defaults. This is the real hidden threat to your portfolio. But now you have the action plan. 1. Reduce your exposure to vulnerable, high-leverage sectors and low-quality bonds. 2. Emphasize quality and liquidity by moving into high-grade bonds, U.S. Treasuries, and cash. 3. Position defensively in sectors like consumer staples, utilities, and high-quality healthcare. Credit cycles turn fast and without warning. The time to prepare is not when the crisis is on the front page of the Wall Street Journal. The time to build your fortress is now, while the market is still calm. If you found this analysis valuable, hit the subscribe button and turn on notifications. We go deep on the financial topics that matter without the mainstream media hype. Thanks for watching, and stay safe out there.